Hi, John. Hi, Mary. How are you? Yeah, great. Thanks so much for coming in. Yeah, everything good? All right. Okay, listen, guys, why don't we just hop right in? All right. So, again, thank you so much for coming in. And, the purpose of why we're meeting today is we're here to present to you a comprehensive financial plan that I've prepared for you both. And the purpose of the plan is really to offer a blueprint for helping you achieve what you're trying to achieve financially and actionable steps for how we're going to get you there, okay? So, our quick rundown on how this meeting is going to go. What we're really going to do is we're going to cover the following financial planning sectors, right? There's 7 of them. And really, we're going to go through all of them in detail, but those sectors are basically going to be, we're going to start with your overall financial health, right? Things like net worth, things like assets, like where you currently stand right now. And we're going to move from there into risk management, right? Things like, insurance policies, home, auto, and, a conversation around long-term care planning, as I know that's important to you guys. From there, we'll go into investment planning, right? A breakdown of where you guys currently stand in terms of your investment portfolio, strengths, weaknesses, steps we can take there. And kind of concurrently moving into retirement planning, right? Looking at what retirement savings you've done so far, how those look, how they're allocated, what can be done, what more can be done, stuff like that. Moving there, we'll go straight into tax planning, right? Everyone's favorite. We'll discuss things like income tax liability as well as estate and gift tax liability. Ideally, how we can get all of those down as low as possible, right? And we'll wrap it up with estate planning, arguably the most important, right? How your estate is going to look upon death, how those assets are going to pass from one party to the next, and how we can make that go smoother for you and hopefully cost you a little bit less, okay? So that's the overall scope of what we're going to discuss here today. Now, just so we're all on the same page, I do want to qualify a few things here, just so, like I said, we're all operating under the same understanding. In previous meetings, we've discussed your goals, right? What you're trying to achieve financially, and we prioritize those, right? We put them in order. And just to confirm, right, starting with the most important, we really want to reduce estate and gift tax liability in whatever ways we can, right? And we really want to ensure that our estate planning documents, they're all in order, right? From there, we want to review insurance contracts and discuss the implications of a long-term care policy. We also want to reduce personal income taxes, right? Don't we all? And lastly, we want to have a diversified portfolio recommended to you that's really going to meet your investment needs and those expectations, right? So, guys, last thing before we really dive in here is, again, just to get all on the same page, I want to cover your all's risk tolerance, right? You've stated to me previously that you both feel that you have no qualms when it comes to investment risk, right? You're willing to assume a moderately high level of investment risk, and that's great. But we also assessed it for ourselves, right, independent of you all, and we also feel the same way, right? We feel that you guys have the capacity and the ability to assume higher average levels of investment risk than what would be normal. Okay, so unless there's any questions with the basics there, I'd like to jump right into a summary of your financial health, right? So as things stand, your current financial situation was reporting a net worth of $11,519,902 and a net disposable income of $1,284,472. Okay? Now look, those are both obviously very strong numbers. And they're going to be the foundation blocks for achieving what you're trying to financially, right? This is the bulk of what we're going to be using to get us, through the rest of your life with a comfortable lifestyle. And so when we start reviewing financial health, the first thing we like to look at is what's called the current ratio, okay? And the current ratio basically measures your ability to pay short-term obligations, right? How able are you to pay your bills, month to month, day to day, whatever, right? It is a very basic but very important view of personal finance, right? And so how we calculate it is we divide our current assets by our current liabilities, right? It's very simple. So right now you guys are operating with about $850,000 of current assets and about just over $21,000 of current liabilities. That gives us a current ratio of 40.15, okay? So what does that mean? A normal sufficient current ratio would be anywhere from about 1 to 2, okay? And yours being this high, while a good thing, right? It shows that you've got great savings, a lot of cash on hand, but it being this high kind of suggests that you might be actually too heavily weighted in cash or cash equivalents. All right, and what that means is that you could be giving up outsized return in other asset classes across the market because you're so heavily weighted to cash. Now, if you guys had a serious liquidity need, or were super risk averse or anything like that, I would look at this a little bit differently. But because you're not, and because you don't, I do feel that this cash balance is a little bit high, but we will get to that a little bit later in the plan. Okay. Next up, John. Congratulations, I think you're in order. Sold your manufacturing company this year for $4 million. That's awesome. That's great, right? Now, the terms of this sale, you let us know. It was paid as a 25% down payment with an installment note for the rest, right? That installment note was an 8-year, 4% note for that remaining balance after the down payment. And I believe these installment payments are coming in. They started in March, and have been going through the year. So while this is all great, some recommendations around what I have for these installment payments coming in would be that we look to, obviously we want to invest at least some of these, right? So what my suggestion here would be to engage in what's called a dollar cost averaging strategy for part of these monthly payments, right? And what dollar cost averaging is basically taking a set amount of money and investing it month over month, quarter over quarter, year over year, whatever have you, into a diversified portfolio. And the strategy is that sometimes you're going to be buying the low, sometimes you're going to be buying the high, but over time it will average out, right? You'll be buying the average price. It's a very prudent way and it's a very smart way to invest slowly over time, right? And so that's what I would suggest with part of it. Now, the other part, this may seem obvious, but I would think we should be using it to supplement retirement income. Right now, that earned income is about to stop, employment income is about to stop. We're going to use this to, help you continue your lifestyle, right? And that's, why else sell a company, right? So that's kind of the plan for those proceeds, because I know they're going to be a big chunk of the assets coming in. And so that's what I'd like to see those used for there. Next up, just to kind of keep running down your assets here, we've got a primary residence, fair market value of about $900,000. No mortgage on that either, which is great. And we also have a vacation home valued at about $750,000. We do have a mortgage on that, and the balance remaining there is about $49,000, and that loan is at 5%, right? So to wrap things up here, financially, we're in very good shape, as I'm sure is no surprise to you, right? We're seeing strong cash savings amounts, although likely not being used to their full potential, but we will get there. Your emergency savings are more than covered. Short-term obligations are getting paid. We've also got very little exposure to current liabilities outside of that small credit card balance that I know you guys intend on paying now that you're back from vacation, and as well as the mortgage on the vacation home, which is more than reasonable and well within your limits. So, like I said, before, I would like to see, that cash balance reduced a little bit, just because I think we're sitting on a little bit too much cash right now, and it's eroding your net return. And I'd like to see that moved into a more diversified portfolio that's really going to be, at a risk-adjusted rate, much more beneficial to your overall return. Okay, so guys, any questions on the state of your overall finances? Awesome. Okay, let me just move my notes here, guys. So moving on, we're going to be covering risk management now, okay? So through some analysis of your current insurance policies, right, everything that you showed us via home, life, auto, and also a review of your long-term care situation, we found some strengths, we found some weaknesses, and I wanted to kind of cover those here with you now, okay? So as it stands, the homeowner's policy on your primary residence, its current face value is about $400,000, and we're currently seeing that the value of your home, not including the land, is about $775,000, guys. Now, a rule on insurance policies is that we like to have at least 80% of that fair market value of the home covered by a policy, right? So 80% of that 775 would be about $620,000 versus the $400,000 policy that you'd have right now. So my first recommendation would be upping that face value of the homeowner's policy up to at least that $620,000, just so we know we're fully covered there, okay? Next, we have the homeowner's policy on your vacation home. Now, the good news is that there's no shortfall in face value coverage here, okay? Fair market value of the home, the vacation home is $550,000. Face value of the policy is $460,000. We're covered, we're good there. Now, where I do see some opportunity, though, is just by definition, guys, HO3 policies, which is the type of policy that you hold on the vacation home, as well as the primary, they by definition do not cover flood insurance, okay? And because of your proximity to the Connecticut River, flood damage is a very assumable risk that you guys have. So what I would recommend is purchasing an endorsement for flood damage coverage to this policy, and I would recommend doing this sooner rather than later, okay? Because there is a 30-day wait period for these types of endorsements to be added that you do need to survive. So I would recommend getting this, on the policy sooner rather than later, okay? Moving on, we have an automobile policy. Now, guys, this I would say was mostly adequate for your needs, okay, mostly. I'm showing bodily injury numbers of 200,000 and 600,000. Those are more than sufficient. I got no problem with it there. But I do see that our property damage coverage is only 15,000, and I think that's a little bit light, okay? I would like to see that adjusted up to somewhere between 50 to 100,000, 50,000 at an absolute minimum for someone in your guys' needs. But yeah, anywhere from 50 to 100 for property damage, I think is going to be more appropriate for your automobile policies, okay? Moving on quickly to life insurance. I'll keep this short, guys. I don't see a need for additional policies at this time. We've got adequate coverage for life insurance with reasonable premiums that you guys have no problem paying. So don't see a need to buy any more here, okay? And then moving on to the big ticket item in terms of risk management is the conversation around long-term care, okay? So I know this was a priority to you all, and so I really tried to dive in deep here. And here's the thing about long-term care policies, guys. They're beneficial when they're used in the correct ways, but also, unfortunately, they're more beneficial when they're purchased at the correct times, okay? And so after reviewing your entire financial condition, it's our position that you are actually healthy enough financially to consider self-insuring against long-term care needs. You guys have enough assets to cover long-term care needs should one or both of you have these needs in the future. And the reason for that is there's a few, but the sweet spot for long-term care policy premiums actually comes earlier in life, as you might imagine, right? I think somewhere between the ages of 55 and 60 is when long-term care starts to become enough of an issue where you consider these policies, but you're still young enough where the premiums are cost effective, right? That's what we call it the sweet spot. Since you guys have moved past that stage of your life, the premiums really start to get exponentially more expensive. So much so that the price of the premiums kind of outweighs the peace of mind that comes with a long-term care policy, especially when you all have the assets to cover it on your own, if that makes sense. And secondly, we actually think it would be more beneficial and more prudent for you to take those premiums that you would have paid to a long-term care policy and add them into your dollar cost averaging plan with the installment note, right? Get those monies invested and growing for you over the long term. That's going to provide you healthy growth and more assets to fund long-term care needs that are not limited by a policy. You have more flexibility, and you won't be dumping premium payments into a policy that you don't really need, right? That is our feeling there, is because your financial structure right now is so strong. Okay, so guys, that's going to summarize the risk management section here. Any questions? Great. Okay, just set my notes. And moving on, we're going to talk about investment planning now. Okay, so I did provide you guys with an investment policy statement as well as an analysis of your current investment portfolio. You should see that there. So I did want to start here on an absolute positive, which is the biggest strength I saw here is that you guys have really done a good job investing both inside and outside of your work-sponsored retirement accounts. That's not always the case for my clients, and it really does deserve to be commended. We're showing about $8 million in invested assets across retirement accounts, the stock and mutual fund portfolio, the annuity, the cash values of your life insurance, and the installment payments as well, right? So why don't we start with the mutual fund portfolio? The thing I saw here was that it's definitely the best diversified, the most well-diversified asset that you guys own comparatively, right? I will say I do think we're slightly overweight in international exposure, and we're slightly underweight in bond exposure, especially considering your age. And I would like to see that evened up a little bit, just from a risk standpoint. That being said, it is a strong overall allocation. I think there's just a little bit of tweaking that can be done here. Moving on to the stock portfolio, guys, this is where I really see room for improvement, okay? We're currently sitting on 4 stocks, and for your guys' age, it's very, very concentrated, okay? So here's the way I see it, right? The portfolio is currently operating at an unrealized loss of $20,000, right? Fair market value is $940,000, cost base is $960,000. That means there's a $20,000 loss there. I would really like to see this portfolio better diversified across more market sectors, and there's a few ways that we can achieve this, right? Number one, stock A. Okay, stock A has a basis of $225,000 and a fair market value of $7,000, right? That is a $218,000 unrealized loss that I would really like to look to harvest, okay? And there's a few reasons for that. Obviously, we don't like selling when things are down, but because there's so much opportunity to rebalance your portfolio here, I would like to sell this stock, realize that $218,000 loss, and then use that loss for a few benefits, right? Number one being, we can use $3,000 of that against your ordinary income taxes for the year, right? And you can keep doing that into the future, right? $3,000 every year. But what would be more beneficial is, other than using that $3,000 against ordinary income, I'd like to use the rest of that loss, about $215,000, either as a carry forward or against realized gains from sales inside your portfolio that I'm going to propose, that would really help us rebalance it out, right? Because any gains that you realize can be offset with losses that you've also realized, right? So really, we've got about $215,000 to play with within the portfolio, if that makes sense. So next step I would recommend is selling stock D, okay? It's got a really high value, $555,000 of value. Guys, that is overly concentrated in one stock, okay? And it's just not providing the return on a risk-adjusted basis that makes it worth it. So what I would say is, while there would have to be a realized gain from selling this. We already have the loss from stock A to offset, and we could use this $555,000 in conjunction with the installment payments, in conjunction with what we're doing in the mutual fund portfolio to really diversify over a balanced portfolio of stocks, bonds, ETFs, mutual funds, to really round us out here, right? And that's really going to do a lot of heavy lifting for your portfolio, okay? Guys, moving on, John's 401k, okay? John, the main thing I gotta say here, I'm gonna sound like a broken record, but it's diversification, all right? You're currently invested in one fund in your entire 401k, and that one fund has a beta of 1, right? And what that means is that it's tracking its broader market index at a 1-to-1 ratio, okay? It's a large cap fund. That broader market is probably the S&P 500. John, at your age, I don't think tracking a large index like that with so much money is necessary, okay? You don't need the return, and we can really pare this back a little bit, to kind of make it more efficient for you. So what I would say, similar to above, I'd recommend diversifying kind of over a balanced selection of equity to bonds, maybe like 70-30, 80-20 even if you're, because I know you do have the appetite for risk, but one large cap fund is just a little bit too concentrated for my liking. So I would suggest a diversification effort there. And look, that can be done either inside the 401k, with the funds available to you, or rolled over into a personal IRA, and I'll have more on that later, okay? And guys, wrapping up the investment planning section here is Mary's 403b. Mary, I don't have much to add here, okay? You're held in a target date fund, 2025, that's good, okay? Target date funds adjust their allocation of equity to fixed income over time, and they become more conservative as you get closer to that target date. We like what they do. They're strong funds. Now, look, it's not the most age-appropriate selection for you, but given your ability to take on investment risk, I don't mind the added risk here, right? It's a retirement account, tax deferred. I don't mind taking the extra risk here, especially because, like I said above, you guys have the appetite for it, okay? So guys, that's going to wrap up what I have on investment planning. Any questions there before I move on? All right. So, moving right into retirement planning. We did, a deep analysis of your retirement plans. And while it is clear to us that your needs in retirement are going to be met, right? Your lifestyle is not going to change. You'll be able to live comfortably into retirement. We do feel that there is room for tweaking and improvement here, okay? So the first thing I want to go over with you is completing your retirement contributions, all right? Adding to your retirement accounts for this year. Now, the reason why I bring it up first is because this is the last year that you're going to have earned income, right? John, you had $11,000 of earned income this year from the business. And the IRS, actually, unfortunately, caps your retirement account contributions at your earned income, right? So at that $11,000. Now, normally for clients your age, retirement account contributions would be $7,000 as a maximum each, right? But unfortunately, we are capped at $11,000 this year, as I said, about earned income, okay? So that $11,000 is a total, and it can be split, however you like, as long as neither of you go over $7,000. What I would suggest is a simple, $5,500 each, just to keep it a nice round number. And I would recommend making those contributions into an IRA. But one step further, what I would really recommend doing here is what's called a backdoor Roth contribution, okay? What does that mean? What I would like to see done is you open 2 accounts at the same time, okay? It's going to be a traditional IRA and it's going to be a Roth IRA, open at the same time. You are then going to make a non-deductible contribution to the traditional IRA, As soon as those funds are deposited in the traditional IRA, you're going to immediately convert them over to the Roth IRA. Same for you, Mary. Okay? And the idea here is to do this as quickly as possible, as immediately as possible, so there's no gains in the traditional IRA that you then have to deal with in the Roth IRA and pay taxes on. But once the funds have moved from the traditional to the Roth IRA, they are now growing tax-free, right? All the growth on those funds is tax-free, and I know that was a focus for you guys coming in. So I wanted to offer that as a suggestion for the way to contribute, you know, your $5,500 each and have it grow tax-free. All right. Next up, in terms of retirement planning, I'd like to address the 401k and the 403b, right? I touched on this briefly earlier, but what I would really recommend here is rolling these over into rollover IRAs, rollover traditional IRAs. Okay. And what this is going to do is it's going to give you more flexibility in the investment choices, right? It's going to consolidate assets for you in one place. It's going to make your financial lives simpler. It's going to give you more control on how your RMDs are liquidated, stuff like that, okay? The rollover is one thing, but going further, once they're rolled over into that traditional IRA, similarly to what we just did with the contributions, I would like to see those assets converted to a Roth in what we call a Roth conversion, right? Similar, they operate similarly to a backdoor contribution, right? What we're doing is we're taking pre-tax money and we are moving it into an after-tax account, right? And so it's going to give you another way to achieve tax-free growth, which I know was a focus for you all. But you know, one thing to consider here, and this is something that I definitely do think, you know, should be thought about, is you do have to pay tax on the amount that is converted. Okay, so just use a round number. For example, let's say we converted $100,000. You'd have to pay tax on that $100,000 going into the Roth IRA. From there, it then grows tax-free in perpetuity. But you know, that one-time tax bill is something to consider, right? Okay, moving on, the last thing here, guys, to talk about in terms of retirement planning are qualified charitable distributions, right? That is basically distributing directly from a retirement account to a qualified charity, right? Now, I'm sure you guys have heard about the Secure Act. One benefit of the Secure Act is that it actually did not raise the QCD age up to 72 as they did with RMDs. They kept it at 70.5, 70 and a half years old, right? So, John, you're 71 years old. That means you are eligible for a qualified charitable distribution. And the maximum amount that you could do there would be $100,000, right? So something to consider if you're feeling charitable, okay? Guys, that's most of what I had on retirement planning. Any questions there? All right. Moving on, everyone's favorite, tax planning. Okay, so we did some various calculations here on the taxable events that you've experienced this year, and so let's get into our findings. Okay. The main concern that you brought me is how these installment payments that you receive from the sale of the business, are going to be treated in terms of taxes, right? So the first thing that is important to consider here is your tax basis in the business, right? Which is $1,075,000. And you know, a very important part here is that a part of every payment that you receive from the sale of this business, part of the down payment, part of the installment payments, will be a return of that basis, a return of that $1,075,000, right? So that return of basis is tax-free. The rest is taxable, and we'll get into that. But it's important to know that part of every payment you receive is going to be a portion of that basis coming back to you, okay? So, how do we get there, right? How do we determine what that amount is, right? Well, what we use is something called the exclusion ratio. And the exclusion ratio is calculating how much of each payment is that non-taxable return of basis, right? So the way we calculate it is we divide our current basis, $1,075,000, by our sales price, $4 million. And we divide that, we get 26.88 rounded percent, okay? So let's do some math. The $1 million down payment multiplied by our exclusion ratio, 26.88%, is going to give us $268,750. Like I said, it's rounded. That amount, that $268,750, is going to be a non-taxable return of basis, right? Not getting taxed on it. The remaining amount, $731,250, is what's called our realized and recognized long-term capital gain. That amount is taxed at long-term capital gain rates, okay? Moving further, like I said above, each installment payment is also has to have the exclusion ratio applied. It's just done a little bit differently, okay? So the monthly payment received is $36,568, right? From there, we have to subtract out the interest from the note, that 4% interest from the note. It's going to be roughly $10,000 taken out. And then we apply our exclusion ratio to that net installment payment of $26,568, right? So multiply that by our exclusion ratio of 26.88%. We get a non-taxable return of basis of $7,140, right? And then our realized and recognized long-term capital gain is $19,428, all right? Again, that's going to be taxed at long-term capital gains rate. And one thing I did forget to mention is that that interest portion that we subtract out, that's taxed at ordinary income rates. Okay, so part of it is taxed at long-term capital gain, part of it is taxed at ordinary income, part of it is a non-taxable return of basis. All right, good. Moving on, guys. Next up, let me just adjust my notes here. Next up, I wanted to discuss the inverted Jenny stamp. All right. So, John, you brought me projections for a sale of the inverted Jenny stamp in about 10 years, right? Compounding at about 8% year over year. It's going to give us a sales price in 10 years of $1,550,000. Like I said, yes, in 10 years. So, making an assumption of a 15% commission on the sale, we're going to arrive at an adjusted sales price of $1,317,500. From there, what we got to do is we got to subtract out the cost basis of when you received the stamp, right? So the cost basis then was $500,000, and that gives us a realized and recognized gain of $817,500. Now, there's a tax rate that we have to apply for collectibles, which is 28%. There's also a net investment income tax of 3.8%. That's going to bring us up to a total tax rate on this sale of 31.8%. We apply that to our real and recognized gain, and from there we get a total federal tax liability on this sale of $259,965. That's a lot, okay? Look, that is a hefty, hefty tax bill, and it is one that I would like for you all to avoid, okay? And while there are a lot of ways to go about this, I'm gonna make a pretty simple suggestion, okay? You've illustrated to me that one of your main goals is reducing as much tax liability as we can, and because you don't need the money from this sale, right, to fund your lifestyle, to continue on as you have been, my suggestion, like I said, pretty simple. It's gonna just be, let's hold on to the stamp for the remainder of your life, John. And what will happen is when you pass, that stamp will get a step up in cost basis up to the fair market value that it is at the time, right? So, like I said, because you don't need the money right now, if we wait until you pass, and when that stamp passes from you to Mary, with her new stepped up cost basis in the stamp, assuming she decides to sell it, you know, pretty soon afterwards, she'll have a much smaller, if any, taxable event because there won't be much time for it to grow or lose value. So instead of taking, a tax hit of let's say $260,000, we avoid that. We hold the stamp. You get to keep the cool trinket for the rest of your life and tell everybody all about it. And then, when you pass, or even, when it passes to Mary, or it passes to, whatever beneficiary you choose, that step up in basis will give them a much more favorable taxable event. So that's my suggestion there. Okay, guys. And lastly, you brought me some itemized deductions that you wanted me to look at. So I went through them and determined what was deductible, what wasn't. And you provided me basically a list. It was various real estate, state income taxes, interest on the vacation home, and some charitable gifts that you made this year, okay? And it totaled about $77,060. Now, it's important to note that in terms of state and local taxes, the SALT deduction, the state and local tax deduction, it will only allow you to deduct up to $10,000 of that amount, okay? So we start with that $10,000 SALT deduction, and then we add in the interest on your vacation home, $2,000. We add in the total charitable gifts that you made of $13,500, and we arrive at a total of $25,500. This amount is the total that is deductible when arriving at taxable income, okay? So given that number, $25,500, I actually recommend going with the standard deduction rather than itemizing, okay? And it's pretty simple. The standard deduction for couples married filing jointly over the age of 65, that deduction is $27,300 versus $25,500 from itemizing, okay? It's higher, it's more deduction. I think that's a pretty easy choice to go with, all right? So guys, that's gonna wrap up the tax planning section. And unless you have any questions, I'm gonna move right into estate planning, okay? So, we did a pretty in-depth review of your current financial positioning, as you know, and it's given us a lot of insight into moves that we can make in terms of estate planning to really improve, kind of where we stand today. So starting off, we start with the good news, okay? If either of you were to pass today, neither would be subjected to estate taxes, as both of your gross estates are currently under the the estate tax exemption amount, and that amount in 2022 is $12.06 million, okay? Now, a few caveats there. We expect to see this exemption amount sunset in 2026, and the general expectation going forward is that it will not nearly be as high as $12.06 million, okay? We actually could see it even cut all the way down to half. So, knowing that this is on the horizon, coupled with the fact that you're set to receive another $3 million in installment payments over the next 7 years, not to mention, growth on your investments, which could easily take us into that exception amount if not handled correctly. Our focus here really should be getting this estate in order as soon as we can, okay? So the steps I'd like to recommend we take here is, first, I want to address the significant probate fees and expenses that you're currently looking at, okay? Guys, as a general rule of thumb, I like to say the more that we can eliminate from going through the probate process, the better, okay? So let's start with the retirement accounts, guys, okay? John, your 401k, Mary, your 403b, both are currently listing your estates as their primary beneficiary, okay? And because of that, both of these accounts are going to be subject to probate, all right? Now, thankfully, this is a pretty simple fix, okay? My recommendation here would be that each of you just list each other as your primary beneficiaries on these accounts in place of your personal estates, right? And that way these assets will simply pass to the beneficiary upon death. It's a very standard transaction instead of having to go all the way through the probate process, okay? And I do recommend making this change to your retirement plans even before rolling them over to an IRA. I know that's more legwork than you might, have anticipated, but you really never know what can happen, and it's important to kind of streamline as much as we can the transfer of assets upon death. And right now, these huge assets going through probate is not what we want. So that's my first suggestion there. Okay, so moving on, John, you've got a lot of assets held in individual name. Okay, your certificates of deposit, your mutual fund portfolio, the vacation home, the SUV, the boat, the stamp, they're all held in individual name and are offering no instructions for what happens upon your death. So what that means, you guessed it, it's going through probate if you were to pass. All right. So let's start with the invested assets, right? The CDs, the mutual funds. What I would recommend is a simple change of ownership to joint tenancy by the entirety. And what that means is that it's going to give Mary equal ownership, joint ownership, over the assets, but it's also going to pass directly to her upon your death, and avoid probate entirely. Now, another route to go here would be to add a payable on death trait to these accounts instead. And what that would do is that it would allow you to retain individual ownership of these assets, but it would pay directly to Mary, similar to a beneficiary on an IRA upon death, rather than going through probate. Okay, so a couple options there. For the vacation home, the SUV, the boat, similar to the above. Okay, I would recommend exploring a changing to joint ownership for these assets, because as it stands right now, their fair market value at the time of death is going to be sent right to probate, and guys, it's such a hassle to deal with. You really want to avoid it. Okay, so John, that wraps up your assets. Mary, the only assets here that would be subject to probate for you are the ones held individually, and those are going to be, like I said, your 403B account and your 2019 Chevy. Okay, your car. We discussed the 403B above, right? Add John as the primary beneficiary. We're all taken care of there. And then, like I said, for John's individual assets above, in terms of the Chevy, explore joint ownership for that account, and it's going to avoid probate for you entirely. Okay, guys, moving on. One thing I didn't notice in your portfolio that you brought me was the presence of documents like healthcare proxies, powers of attorney, even trust ownership over your accounts, and that's something I would really recommend getting in place, because it's going to make your affairs go much more smoothly should one of you become incapacitated. And that kind of leads me into my final point here for estate planning, is that an appointment with an estate planning attorney, and this is why I wanted to end on this, is probably the most important recommendation I'm going to make for you guys today. Okay, it's really going to help you guys get your affairs in order. They can set up all sorts of stuff for you, trust ownership to make the transfer of assets go even smoother. They can help you really streamline the process of asset transfer at death, even more so than what we went over today. They can help you set up those healthcare proxies, those powers of attorney. They can tell you the best way to have your accounts held in ownership. And look, I'm happy to recommend a few relationships that I have for myself from doing this job that could really get you in the right direction in that front, should you so like. Okay, so guys, listen. Before I move on, any questions on the estate planning portion of this plan? All right, good. So listen, I really gotta thank you for hanging with me. I've got just one more piece here, and then I'll let you go. All right. These are the action items. Okay, these are gonna be points that you've heard me make throughout this plan already. But I really did want to, kind of as we wrap this plan up, I did want to kind of summarize what I believe to be the most important actionable items for you kind of to both focus on. Look, I know I went through a lot today, and it's not going to be all of them, but what I decided to do was kind of pick one item from each section of the plan that we went through that I believe is the most important, and just to kind of really drive the nail home, because these are going to be the things that I would try to focus on first, right? So from the summary of financial health section, what I would recommend is reducing those cash or cash equivalents pretty significantly, okay? We know that your current ratio is over 40 right now, which is extremely strong, and really you're giving up the opportunity of higher returns elsewhere in the portfolio by holding this cash that's just getting eroded by inflation, okay? Because you don't have a serious liquidity need, I really think that this balance can be reduced pretty significantly, spread over a diversified selection of stocks, ETFs, mutual funds, etc. And that's really going to optimize what you're doing in the investment space. All right. Moving on to the risk management section. Now, while I do think that minor things like increasing the face value of the home insurance policy or adding the flood damage endorsement are very important, the main thing I'd like you guys to address with yourselves and think about is your ability to self-insure for long-term care, okay? Your financial position has proven that you are able to absorb the cost of long-term care without a policy in place for either of you. And I would really urge you to consider this route, because the investment opportunity that you can make with those premium payments is going to be a lot more substantial at this stage of your life, just because we have aged out of that sweet spot where the premium payments on long-term care policies are cost effective. And right now, I think you're paying too much of a premium, excuse the pun, for what you're getting on that front, okay? Moving on to the investment planning section. My recommendation here is kind of broad-based. It's an all-encompassing diversification of your portfolio, okay? This includes the cash management piece, right? Reducing the cash in your cash equivalent section. It includes balancing out the international and bond exposure in your mutual fund portfolio, harvesting the huge loss in your stock portfolio to use against future gains in efforts to rebalance your portfolio, and deconcentrating out of those 4 stocks and spreading it out over a diversified equity and fixed income allocation. John, like I said, diversifying that 401k balance, right? We got to get it out of that just one large cap fund and really spread it out over multiple asset classes. And less importantly, you can do that, like I said, in the 401k plan, outside of the 401k plan in an IRA that we eventually, convert to the Roth. You got a lot of options available there, but the main point is we've got to diversify this thing across multiple asset classes, because the investment portion of your portfolio is a little bit too concentrated for my liking. So that'd be my suggestion there. Guys, moving on to retirement planning, okay, and I just touched on this as well, is I'd like to see both of those backdoor Roth IRA contributions done. This is the last year we're going to be able to do it unless one of you guys goes back to work. So let's get those completed. I'd also like to see the Roth conversions of your 401k and 403b, right? Roll them over to additional, then to a Roth. Now we're growing tax-free. Of course, the one thing to consider there is the tax payment that you'll have to make on the conversion amount. But what you're getting by giving that up is tax-free growth in perpetuity, which I know was important to you, okay? And guys, moving right along to tax planning, everyone's favorite. The big action item I have here, and this is going to be an easy one, is actually to do nothing with the inverted Jenny stamp, okay? Simple fix for a problem that you don't really have, okay? Hold on to it until death, pass on to the next party. That party is going to get a step up in basis. It's going to help you avoid a large taxable gain by selling it now when you don't need the large influx of cash. And like I said, because you don't need that cash, it's not going to negatively affect your portfolio. You don't need the money to live on right now. Keep the stamp, sell it later on in life. It's going to create a more generational wealth growing opportunity than selling it now when you don't really need it. And guys, I have a feeling you're going to be able to guess what my recommendation is for estate planning. It's my most important one, and it is to meet with an estate planning attorney. They are going to help you get your affairs in order in terms of the passing of assets upon death. They'll be able to set you up with, a much more streamlined process, whether that's, just simple account ownership changes, if it's going the trust route, if it's going things like charitable remainder trusts, things like ILETs. I'm not even going to cover all of that with you guys today, but it's all options for you, and they will be able to, give you a peace of mind that, the succession planning for your family is going to be taken care of. Okay? So, guys, thank you so much for hanging with me, listening to my spiel here. I really want to thank you, for the time and, the opportunity to discuss your financial lives with you. It's been a pleasure, presenting this plan to you both. I know it was long. I know you probably have a lot of questions that you haven't thought of yet. And if you do, you know how to reach me. I'm around whenever you like, okay? Again, guys, thanks so much. Have a good one.